Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Christy Akulian from BlackRock. BlackRock, which we know is the world's largest asset manager with about $8.5 trillion in assets under management. We're talking about the market outlook and investing strategies for the second half of 2022. Christy is a director on the iShares investment strategy team. Christy, welcome. Great to have you on the show.
Thanks, Nina. Thanks so much. It's really great to be here.
So let's talk about the recent market action first. It was a brutal first half for stocks as well as bonds and most other asset classes. But stocks have rebounded this month. And for reference, we are talking in the afternoon of July 20th. So I think this rebound is due to belief by some investors that the sell-off has reached a bottom, or it could be reaching a bottom. And the second quarter earnings season so far has been better than feared. And those results have kind of soothed investor concerns about the impact of rising inflation and higher interest rates on companies' earnings. So let's start with your thoughts on the recent market action.
Yeah, I think that's a great place to start. As you mentioned, it's been really an incredibly painful spring and summer for a lot of investors. And, I think that when we look at the investing landscape right now, we see that markets are really being moved by kind of a combination of both macro factors and also some technical ones as well. So on the macro front, I think that investors are really, and you touched on this too, facing kind of these twin worries about inflation and slowing growth. So I won't say the R word just yet, though I assume we'll probably get there throughout our conversation. So really what we've seen over the last couple of months is that investors have really sort of ricocheted almost between these two primary concerns, right? So every time we get a new piece of data, it's sort of evaluated for what it might mean for inflation and what it might mean for growth. So where I think that leaves investors at the moment is really with very low conviction. So I think that's one of sort of the hallmarks of the market moves that we're seeing over the last couple of weeks and even the last couple of months. So I mentioned that was a combination of macro and technical things that we see. On the technical front, and maybe one that I don't think investors pay quite as much attention to, but I do think is equally important here, is positioning. So what we see in the market right now is a very, very low level of positioning, particularly from the institutional community. So just one kind of technical factor that we look at or metric is we look at S&P 500 E-mini futures. And those for us are sort of a benchmark for what institutional investors are doing. So where we see futures right now is their positioning is the lowest level on record. So we've seen just a ton of shorts enter the market, right? So we're seeing lots and lots of hedging. So as a result of some of that very low positioning, we've also seen really low liquidity. That's not really unusual in the summer months, but it's much worse than we would see in a typical July. So I think that combination of sort of low liquidity and low positioning is exacerbating some of the moves that we've seen in the market, right? So in the first half of the year, we've seen more than 20% of all of the trading days have had moves of more than 2%. That's really remarkable in a historical context. That's more than we saw in 2020, for example, and it's much more in the average year we see about 3% of days. So an important takeaway, I think, for me in terms of what I'm seeing in current markets and really what's played out over the first half of the year is a trend that we've seen particularly in the ETF space. And that's really that investors of all different types, so both institutional and retail and kind of everybody, are using ETFs to manage around some of this volatility. So almost irrespective of like the asset class or the specific risk or trade that we're talking about, we're seeing them use ETFs more to do that. Right. So, for example, we've seen liquidity get really tough in the bond market in the last couple months here, particularly in the last month. And as a result, we've seen some institutional investors trade fixed income ETFs instead. we've seen some really large portfolio rebalances against some of that, the pretty poor performance in both stocks and bonds year to date, and also in the face of some of the geopolitical concerns, right, that we saw earlier on this year. So we've seen financial advisors and individual investors really turn to fixed income and treasury ETFs in particularly. So one metric that we look at in kind of the face of the recent market action is just, how much investors are using ETFs or not. So we look at the market share of total equity trading that ETFs take. And right now, and what we've seen so far this year is that they've really reached their highest ever share. So ETFs have made up about 43% of all trading on some of these most volatile, most choppy markets. So I think one thing to take away from that is really that investors aren't just thinking about what they hold, but they're thinking about how they hold it too. So those are kind of some of the things I'm looking at in the recent market, and just the guideposts that I'm watching in terms of investor behavior as well.
So you mentioned low level of positioning, and we saw that from Bank of America's recent monthly fund manager survey. We saw that exposure to risk assets has gone down to levels not seen even during the global financial crisis. So that kind of suggests capitulation, right? And it seems everyone was waiting for that capitulation. Whenever I watch CNBC or Bloomberg, all experts say that stocks are not going to rebound till we see capitulation. So do you think stocks have already seen that capitulation that everyone was waiting for?
Yeah, no, that's a really great point, and I know it's one that gets referenced pretty frequently. So there's some conflicting metrics here, right? I think that on the one hand, on the institutional space, as I was talking about earlier, we're probably close to that. So we're seeing really low levels of positioning on the institutional space to the point where I think that any market rips higher are actually problematic for the institutional community. So we're observing them looking to hedge their right tail as opposed to the left tail. So we're seeing call options for expensive get more expensive than put options because everybody is already pretty hedged. So from that perspective, I would say, yeah, that looks a lot like capitulation. But interestingly, we're actually not seeing that from the retail community. And one of the signs that we look at for that too is just ETF flows. So even though it's been such a difficult year for equity markets this year, we've actually seen really positive flows into equity ETFs. So we've seen about $200 billion of new assets flow into equity ETFs in the first half of the year, which is honestly close to a record and close to last year when we were, having a massively higher year. So very different macro situation. So what we have seen in the last month or so is that those flows have slowed, but we haven't seen a reversal. So I don't think that I would say we've seen capitulation from the retail community just yet. And I think that over the last few years, if you look at kind of the total share of ownership between institutions and retail, we've seen retail become a bigger, more important part of the ecosystem. So I wouldn't say that we're quite at capitulation, but I do think that those low levels of positioning are what's causing some of those really big moves that we see on relatively minor news releases too.
You're right. ETF flows have been really impressive. That suggests that ETF investors are much more resilient. So now let's talk about inflation, which is the biggest headache for investors lately. And the recent CPI and PPI report for the month of June were hotter than expected, but there were some signs, and so there are still some hopes that inflation might have peaked in June, because oil prices have come down significantly. There are some signs of easing of wage pressures too, but cost of shelter is likely to remain high. So the biggest concern for investors is whether the Fed would be able to tame this high inflation without sending the US economy into a recession. What does BlackRock think about that?
Yeah, I think this is the $1 million question, right? So I think that this is the one that's occupying most investors' minds right now. So if I may, I'll kind of take this one in two parts. So maybe I'll give you two $500,000 answers for the $1 million
Sure.
question, if that's okay. On the sort of the direct front, to answer your question directly, I think that we acknowledge that it's definitely getting harder to engineer that sort of soft landing that the Fed talks about, right? So our base case is actually not that we're going to tip into recession in the next 12 months or so, but we do acknowledge that the likelihood of that is increasing. So our expectation really in terms of the Fed is that we think they're going to continue to move pretty swiftly to contain inflation now, but that ultimately we think that we're going to get to a place where they're going to need to pause. And then we're going to see a little bit more of a dovish pivot away from this almost overly hawkish tone that we've seen from them when we start to see signs of weakness in terms of growth in the economy. So our outlook is that we think that they're going to live with inflation that's a bit above target for longer. And the primary reason why we think that is because doing so, or not doing so, the risk of not doing so would severely crimp growth. So one of our recommendations in that scenario and sort of how we see the Fed and the recession question playing out is to look at something like STIP. So that's the iShares 0 to 5 year TIPS ETF, which gives you exposure to short dated Treasury inflation protected bonds, which we think should do well if near term inflation continues to kind of come in above expectations like we saw this month and the last several months. So kind of Nina, if I can, expand a little bit on that question though, and step back from sort of the immediacy of whether we're heading into a recession or not. I think that, outside of that 6 to 12 month view, BlackRock's outlook is really that we identify that we're moving into a new regime. So not just a new phase of the business cycle. So in our mid-year implementation guide that we just published, we talk a lot about kind of the end of the great moderation. So we identify that as really a period of stable growth and stable inflation. And we think we're moving into a more volatile future for both of those things. We see the Fed as being more of a source of volatility now rather than a dampening effect. We think there's going to be greater trade-offs between policy that sort of curb inflation and then policy that doesn't stifle growth. So it's kind of that belief, I think, that broader regime change, if you will, that really leads us to the three themes that we're thinking about going into the rest of the year. And those are really embracing volatility, living with inflation, like I mentioned, and then some of the longer term impacts that we see from shortages, particularly in the commodities complex.
So we'll definitely discuss those themes one by one. But before that, I just wanted to ask you, what can investors expect from the second half in terms of equity and fixed income performance? Because the first half was brutal for them. Both stocks and bonds fell at a pace which was not seen in decades. And there are some concerns about traditional 60-40 portfolios also now, because in the past, these traditional portfolios provided some diversification benefits because stocks and bonds usually had a negative correlation. But this year we saw that they were moving in lockstep. And so investors were concerned whether these traditional 60-40 portfolios deliver the kind of diversification that is required. So I have seen that some advisors recommending addition of alternatives in the portfolio. So what are you telling your clients about what they can expect from the second half and whether they need to make any changes in the traditional 60-40 portfolios?
Yeah, I think it's a really great question. So the first half of the question, in terms of what to expect for the second half, I'm afraid it's not an overly bullish picture for risk assets, right? So we really do expect that volatility is going to stay high. We expect that inflation will stay sticky. And then we think some of these shortages across the commodity complex that I sort of hinted at earlier, we expect this to sort of remain a problem even in a post-COVID world. So take a little bit longer to work through the system than I think investors currently realize. So a great point in terms of what does that mean for a 60-40 portfolio? Because I think that's the question that's on most investors' minds right now. So it's obviously been a really hard year for that sort of universal benchmark, if we will. We've seen stocks down about 20% in the first half, bonds down about 10%. So there hasn't been a lot of ballast or diversification, as you were mentioning, from holding bonds in a portfolio. So, I think that as we see the world, the end of that great moderation really means that we're going to continue to face, trade-offs between living with inflation and stifling growth. I don't think that we believe that is the end of the 60-40 portfolio by any means. I think that really just means that both the equity and the fixed income sleeves need to be updated to kind of reflect the newer reality of higher volatility and higher inflation. So what do I mean by that? I'll give a couple of examples. So, within the equity sleeve, we think that investors should be adding to sort of defensive and risk-reducing strategies. So low volatility or minimum volatility strategies, something like you would get in a USMV ticker. We also really like adding to sectors and industries that have strong pricing power, because we think those are what's going to be best suited to be able to weather the higher inflation that we think we're going to be living with for longer. So what our research screens for that is things like pharmaceuticals. So IHE would be the ticker for that one. Healthcare providers, for example, so IHF. So there's ways to think about the equity portfolio that lets you stay invested, but lets you get a little bit more defensive, both for volatility and for inflation. And then within the fixed income sleeve of that 60-40 portfolio, I think there's really more of a silver lining here. So, if you asked investors, even just a few years ago, what really one of their biggest concerns for retirement or their long-term goals more broadly, it was that lack of income, and the search for yield was really a preoccupying search. So I think that as interest rates reset higher, we see opportunities in fixed income, and particularly where we see our opportunities right now are at the front end of the curve. So we like this sort of trade that's kind of up in quality and down in duration. And a fund like IGSB gives you some exposure to really high quality, short dated credit. And then, on the other side, a fund like STIP, it again gives you kind of front end inflation protection. So we like that there's yield to be found from bonds, and we like getting it from the front end of the curve, given both that we think that kind of this peak Fed hawkishness is sort of already priced in, and also because where you see the yield curve right now inverted, I think that leads us to prefer the front end of the curve and take a little bit less risk and get a similar yield profile for that. And then lastly, I know you touched on alternatives too. I think that for some investors, one of the things that may change about 60-40 portfolios going forward is that it may not just be a binary between stocks and bonds. We may be looking at more of kind of a three-way split between stocks, bonds, and then maybe a small allocation to commodities. So given some of the shortages that we've seen in sort of energy and in food this year, which we expect to persist, a broad and diversified basket of commodities, so something like COMT, that could also provide a little bit more inflation protection. So, instead of 60-40, we may see a little bit different split that leaves some room for alternatives or commodities within it as well.
So you talked about the impacts of shortages, particularly food and energy shortages. And the war in Ukraine has kind of exposed that we are so much reliant on fossil fuels. Everyone wants to transition away from fossil fuels towards green energy, but there's still a big gap between renewable energy supply and the demand for energy. So do you think we will see a resurgence of investment in fossil fuel production in the wake of these shortages?
I think resurgence is probably too strong of a word. I would stop short of saying that. And partially, I think that really a lot of the reasons for underinvestment that we've seen in fossil fuels, they still remain. Right. So we see this long CapEx cycle. And then importantly, we see a more challenging future outlook in terms of regulatory pushback and that net zero journey or transition that you described earlier. But I do think that some of the kind of historic underinvestment could be addressed in the space to meet near-term demands. But really importantly, I would draw a distinction between the short term and even the medium term, if we're thinking about that way, where I think that clean energy sources are going to be more in demand. But I think that the way that we're thinking about addressing shortages and the way that we're thinking about sort of near-term opportunities and long-term solutions in an investor portfolio are very much that fossil fuels and clean energy are going to need to live side by side, right? So we don't think that it's one or the other. We think that both have a place in a portfolio. And I think that the time frame is really what's going to differentiate between those. So we think that transition between, fossil fuels to more green energy sources, it's going to be a bumpy one. So we don't, again, we don't think that it's one or the other. We think it's really going to be both for quite some time. It's not a smooth baton pass, if you will. It's not that one is going to wind down at the same time that one ramps up. There's going to be some overlap. But, I think that higher fossil fuel prices for right now can actually be a good thing in terms of that net zero transition that we're talking about as well. So as we see higher fossil fuel prices, we also see opportunities in the green or the clean energy space as well. It makes those solutions more competitive. It encourages investment. So, at the same time, I know we've talked a bit about energy equities, for example, as being opportunistic within a portfolio right now, given some of the fundamentals and the dynamics, especially you mentioned earnings season. We expect to see really strong earnings for them. So we see opportunity for something like IYE in a portfolio, which is, again, energy equities. At the same time, we see opportunities for something like ICLN. So that gives exposure to more of those long-term solutions that I mentioned earlier in terms of the clean energy and that net zero transition.
So very interesting thoughts. And we all know that climate change is real. In fact, we have seen a surge in these extreme weather events lately, including wildfires, heat waves, major flooding. And we know that all these are caused by global warming. And we all agree that the transition is not going to happen in days, years. It may take more than a decade or so. So what does that mean for the goal of transition to net zero by 2050? Do you think we'll be able to achieve that goal, particularly in view of this increase in fossil fuel production that we may see in the coming years?
Yeah, it's a big and it's an important question that I'm probably not qualified to answer in its entirety. I think that what I can speak to though is really the way that investor portfolios can be positioned around that. So I just go back to the idea that for the near term, we really the world needs more energy. That's kind of the hard stop. And so wherever that comes from, whether that's from traditional fossil fuel energies in the near term, and then gradually over time, that's going to be a larger and larger share of the energy is going to come from green energy sources. So yes, I do still think that we're on a path towards that. Like I said, I think that some of the higher prices right now in fossil fuels, particularly oil, that we've seen as a result of the Russia invasion of Ukraine, as well as the global reopening post-COVID, I think that counterintuitively almost that can be a good thing for the net zero transition. So as I was mentioning earlier, I think that it's a really important, the price point being high is really important for investment in clean energy. So those alternative energy sources can become more competitive. They can be profitable even at higher price points. So yeah, I do still think that we're moving in that direction. I think that we always anticipated it would be a bumpy road to get there. But I don't see anything deterring us from getting there in the end. And importantly, I think that we should call out, and one of the things that we talk about in the mid-year implementation guide is that this isn't just a problem in the energy space. It's also one that we're seeing sort of bubble up and become more prominent in food and in agriculture as well. So I would say that similarly to the way we look at kind of the barbell approach, if you will, between traditional fossil fuel energy and then longer term solutions in terms of clean energy exposures, we have something very similar in terms of what we look at for food production as well. So, we have and we recommend within our mid-year implementation guide two funds that really address kind of that near-term opportunity, not long-term solution within the agriculture space as well. So we look at VEGI, which is more of a traditional agricultural companies, fertilizer, et cetera, as being that near-term solution. And then we look at IVEG, so IVEG, if you will, is really being more sustainable, kind of the future of food solutions. So there's a really strong parallel between what's happening in the energy complex and then what's happening in food and agriculture as well that I think is important to note.
Excellent stuff. That's all we have time for today. Christy, thanks so much for joining us and for sharing your insights.
Thanks so much for having me.
So that was Christy Akulian from iShares. Let's quickly recap some of the ETF tickers that she mentioned. She mentioned iShares USA Minimum Volatility Factor ETF, ticker symbol USMV, which is actually a pretty popular minimum volatility ETF. She also mentioned iShares Core High Dividend ETF, ticker symbol HDV. Among inflation beneficiaries, iShares Short-Term Tips ETF, ticker symbol is STIP. Also, iShares Pharmaceutical ETF, ticker symbol IHE, and funds that are positioned to benefit from continued food and energy shortages. iShares Emergent Food and EdTech ETF, ticker symbol IWEDGE, and iShares Global Clean Energy ETF, ticker symbol ICLN. Also, iShares US Oil and Gas Exploration and Production ETF, ticker symbol IEO. And another ETF for food shortages was iShares MSCI Global Agriculture Producers ETF, ticker symbol VEGI, VEGI. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.